Hi, I'm Peter Rose, founder of Longwood Currency Trading. You know, why letting your Forex winners run probably isn't working for you. The traditional trading slogan goes, cut your losses short and let your winners run. I want to go back to something that I talk about all the time in my videos. It's evident to everybody that's out there, but very few people actually talk about it. I mean, it's at the crux of trading as far as I'm concerned. And that's that you have absolutely no control over how much you're going to win, let alone if you're going to win. But you have absolute control over how much you're going to lose. You have control over your losses. So the saying says, cut your losses short. Okay, I can do that. And let your winners run. Well, what does that mean? I have no control over my winner. I mean, I have a probabilistic expectation when I go in and do my entry analysis that the trade is going to be successful based on the probabilistic estimation of the price continuing in the direction that it's continuing in with increasing momentum, not necessarily volatility, but more momentum, and that I've picked a profit target that's within reasonable reaching distance for the time frame that I'm trading on. But that's all probability. Cutting a loss is not probability. You cut it. The question becomes, well, when do you cut it? Well, the entry stop loss solves that problem. And I talked in my last video about how you get out of, when you get out of a trade that's running, when to cut that trade. So what about this winner thing, letting your winner run? Well, if the winner leaves the entry point and goes in the direction that you want it to go in, that's a winner. Do you cut it then? If you're not going to let it run, do you cut it at a 5-pip profit? Do you cut it at your profit target? And do you? I mean, how far do you let it run? Oh, Peter, well, we'll let it run to our profit target. And what good's that going to do? Because if you have 2 or 3 bad trades, you've wiped out that one really big one that ran, maybe. You have no control over how much you're going to win or if you're going to win. You're lucky that the probabilities that you determined have this price that is in profit. I have 2 distinctions in that in profit situation. In profit means you didn't get stopped out, that you've got that it is in profit. And it's going somewhere. When it gets to your profit target and you say, gee, this looks like it's got the momentum to keep going on beyond my profit target, once it goes past that point, I call that a runner. So that's the maybe let your winners run where that comes into play. It's after the profit target. Letting your winner run is secondary to getting to your profit target. And again, as I've discussed in my last few videos, the profit target really isn't a profit target. It's a estimation of where order flow congestion has occurred based on your analysis of the chart and the likelihood of your particular trade having enough momentum to go through that, you feel is reduced. And so you would expect resistance to your price action as it moves into that cloud or that zone of order congestion. If the price is continuing with the same amount of momentum dynamics into that profit target cloud that we call it I call it a boundary condition. Now you've got a runner. So now your thought process changes. As that thing is running through there, you quickly bring your stop up and trail your stop behind that, because you can't let that winner run just by walking away. You've got to float a stop behind it, because if you don't, which is probably what a lot of you don't, you're sitting there, you're going, well, that's going to go to the moon, and it's not going to come back, and so I don't have to set my stop. And you come back in the morning and the thing is gone 200 pips in the opposite direction. You say, oh, you're not going to let that happen. I've had that happen to me quite a few times, until it finally dawned on me that I have no control over that runner. I have no control over that winner. You say, well, yeah, but it's got all that momentum, and I don't want to get out of the trade. I want to let that profit grow. I want to get 40 more pips. Well, you've only gotten 20 so far, and it's moving. So I don't know how your expectation is to get 40 more, but you don't know. I've had trades positions that I've got out, and the fucker ran 800 pips without me. But that's okay, because I made what I set out to make. Well, my former stockbroker, Joe, told me one time about, and it has to do with greed. He says, when you get on a train, you pay a ticket to get off at a certain stop, at a certain station. You don't give a shit where the train's going, because your desire was to get off at that particular station, to go to work or to sightsee or whatever you're going to do. You don't care that the train is going to go on any further. You get off at the station. And so if you set a profit target and the thing is moving in that direction, you can just sit there and let her go. Or remove the limit order and watch it. But you just don't remove the limit order and float your stop at that point, because that's a recipe for losing 8 pips without even thinking about it. Again, we're day trading here, so 8 pips is a lot of freaking money for a day trader. When you're looking at letting that winner run, you're probably looking at letting the trade run from where the initiation point was. And that's a greed move. And that's not time to be greedy. That's time to be fearful. Until that position that you have has gone sufficiently far that if you got out there, that you would be happy with the percent return against the current risk that you have. What percent risk is that? 0.1%, 2%? I don't know. That's up to you. I have my guidelines that I teach in my course. And people say, oh, I'm never going to make any money that way. And I go, well, you're not going to make any money doing it the other way, because you'll end up losing your account. You'll reload that account. You still won't know what you're doing. And you're going to lose that account. And you're going to continue to lose because you don't understand what reasonable is. You don't understand when to be fearful and when to be greedy. Until that price gets to a point where if you got out right then, you'd be happy, then you have to be fearful. Once that price goes beyond that and you can bring the stop up and lock down, now you can be greedy. Now you can start thinking about, well, how do I let this thing run? Then the question becomes one of not so much floating the stop behind it, but based on the, maybe you picked the right direction on an NFP, and for some reason, usually you have these economic releases, and the price goes way up, and then it comes way back down, and it goes back in the other direction, and then it comes back up to basically where it was, and then gradually will take the direction that the news indicated that price might want to go on. And there are reasons why it does that. But let's say you just got on the right side of it and it's still going. Well, you have an entire market's sentiment in your favor. including the institutional traders. So that thing could run for a long time. Okay, you're on a 5-minute chart, or you're looking at the thing and you're saying, well, generally a pullback on a 5-minute chart would be X number of pips. Now you're into maybe trading the daily because you're letting that winner run. It's gone beyond your profit. Let's say you had a profit target of 20 pips. It's gone beyond that. So you're 20 pips up. So you're 40 pips beyond your take point. So you're in high cotton. If that thing had the, and I've seen some of those trades go 300, 400 pips, 800 pips. But you're saying, if you want to be there for the 800 pip run, you can't have a stop. Or it's got to be a stop so far out that all you get is your initial profit target amount, let's say, or maybe you float the stop 40 pips below that. And then you're going to get mad, right? Because, oh, here's a profit, then came back down 40 pips and I only made 2% on that trade, and I could have made, because I was 6% up when the trade was there. Yeah, but you don't have any control over the winners. So until you take your chips off the table, the game's still going. And you don't know what's going to happen. If you set your stop short behind a big winner, you'll get stopped out. And that thing will turn around and will continue to go. That's where these guys do, they call it set and forget. Set the price and let it go. Some of them float stops, some of them don't. Some of them say you missed the real big moves. You're in profit, all that money. And so you set your stop way down below and let it go. And if the thing comes back, you still make a good trade. But you only made the amount of money for a good trade at a percent return against your risk over what? You let that thing ride for 2 or 3 or 4 or 5 days, and the thing has come back down, and now you win basically a really good 1 day's wage, and you've wasted 3 other days where you could have made half that. You could be 3 or 4 times up on that daily profit when the thing turns around and continues to go, and it didn't, and you were out of the market because you waited and held that trade, and it came back and took your account. Some of the guys that don't set stops, they lose all that money. I'm up, I'm trading a 1 lot and I'm 500 pips up. That's a lot of money. And you held that for a week. And so you've got to stop because the thing comes down 200 pips and then it goes up, back up 200 and then another 50 beyond that. And you have all this gyration in it. And if you're happy to take a 1% gain on that one trade when it comes all the way back at you, and you've had that for 5 days, so you made 1% on that daily trade, but you've missed out on the other 4 days that you could have made 0.5%. So if you wouldn't have taken the trade and done that runner, letting that profit run, you could have made 2%, and now you've made 1%. So you've lost 50% of your potential. Those big runs don't come around very often. A lot of these guys that are doing this type of trading on Videoland that you're watching, they have massive amounts of banks. They gain all this money, and it comes down and they lose it all, and it doesn't matter because they haven't touched a principal. In my real estate career, 40-year real estate career, I lost $1 million net worth twice because of economic collapse in the real estate market. But I never lost my base assets that was built on because I understood what my risk was. And so I lost $1 million twice in my life, but I made it back each time, but it took 10 years each time. And the risk management of that principle is trying to be implemented into the currency market, and it's crazy. In the real estate market, you might have a 30 or a 40% downturn once every 10 years or something. And then it'll go up 8% a year for the next 10. So when you are looking at the currency market, you could get a 300 pip turnaround tomorrow on that winner. And because you're not fearful and you're not floating that stop close enough to that to preserve as much of the gain as you could have, because you're not happy with that, you're being really greedy, you're a pig. Well, this thing is going to go to here. Well, maybe. So if it's going to go to there, float your stop 10 pips below or 20 or wherever you think it's consistent, and just trade it on up. And you'll miss the last 10 pips of that move or 20 pips of that move. But to set your stop way down here is crazy. And if you're thinking that way when you're starting out at your entry, you're going to have a hard time. That's why it's not working for you. I've been through this before many times. I lost 6 figures one time because I got the timing wrong on when just to get out of the trade. So I think I know what the potential is to happen when you do that. Well, the letting your Forex winners run is a great idea. It's when do you implement that? Remember, what do I need to do? How do I need to do it? And when do I do it? So just to sit there with a stupid platitude of cut your losers short and let your winners run is stupid. That may be what you end up doing, but if you don't know how to do it and you don't know when to execute that on the winner's side, you're going to be just as jacked up and crippled up as if you ignored putting an initial entry stop on. So be aware that all these people that are out there talking about this stuff, they may be saying the right thing, but they may not know when you're supposed to do that. And quite frankly, when for me may be totally different than when for you. But there's got to be a when component there. And it's got to be in one of your static trading rules, not in your day-to-day execution rules, in your entry analysis, your position management, or your exit methodology rules. They're not in there because that's an anomaly situation. Letting a winner run only happens under certain circumstances, and those circumstances are static rules, circumstances that you never touch. You're not understanding how to construct layered rules. You have static rules and then you have operational rules. And this is one of the toughest things that I have to do when I'm working with a trader in my course. Is the thing is premised on what do we want to do all of the time, and what do we want to do that's condition based. That's how you create your trading plan, with the framework built into the trading plan of these static rules and these more dynamic rules based on conditions. So if you don't understand how to do that, send me an email, and maybe I can point you in a direction where you might be able to figure something out that will give you a little bit more information, or maybe I can help you out. If it's just a simple question, I'd be happy to answer that, even have a video conference with you. But if it's more complex than that, because it is, you may feel that just the simple answer doesn't give you the background that you need, and how could it? That's why you go to college or go to high school. You can't be a freshman in high school and start studying advanced algebra or high school, maybe even calculus right away. You have to build the foundation of the math behind that. You can't just start studying 19th century history for your country without understanding 15th century history or 17th century history, because that forms the basis. And so a lot of the stuff that I talk about are these static rules. And you have to have a basis of understanding, a basis of preparation in order to go, oh, I need to do this all the time, as opposed to when this condition and when this condition and when this condition hit, then I do this rule. That's the difference. And that's what taking a course from someone who knows what they're doing is going to be helpful for you. I mean, look, what, you don't want to spend money on a course because the person doesn't know how to teach. That's the fear that you have. You're going to pay that money and the person doesn't know how to teach. Listen to the videos on the people that you're thinking about taking a course from, and see if you're getting from the communication from them that there's an organized process that they're going to be teaching you. If you're going to open a course up and they're going to be teaching you about sizing your fucking bank and Bollinger Bands and shit, you don't want to do that, because none of that has anything to do with trading. You got to learn trading first. Then you got to learn how to apply those trading principles against order flow of the market that you're considering trading, because order flow is going to be different in a commodity market, a sugar market, than it's going to be in a lumber market or currency market or car sales. So when you're looking at price action, it changes even on a currency pair basis. So there's rules about what currency pairs that you trade and why you trade them. So if you need some basis of understanding of what you don't know, well, give me a call or listen to my videos, because I get comments in emails all the time. Gee, I didn't know that. Well, I knew it, but I didn't know it the way that you were talking about it. And so maybe I can help you out do that. In any event, why letting your Forex winners run isn't working for you, I hope I've helped resolve that for you. The way that you do that is don't consider a position that you have as a running winner until it gets to a certain point where you can protect a certain amount of your profits, such that if that thing runs for 5 days and comes back and hits that profit target, that profit target that you gain pays for some of the time where you weren't trading because you were waiting for that winner to keep on going to infinity, and it didn't. Peter Rose, Longwood Currency Trading. Have a great day, and have a great trading day.